The oil industry is bracing itself for a perfect storm of challenges, with a potential contango and a slowdown in shale production threatening to disrupt the market. But here's the catch. It's not just about the oil. It's about the global economy and geopolitical tensions too. The looming contango. A contango is looming over the oil markets, with the entire 2026 WTI futures curve trading below $60 per barrel, a price that makes most new shale wells unprofitable. This situation has industry leaders concerned, including Total Energy's CEO Patrick Pouyanné and Vital's Russell Hardy, who predict a reduction in U.S. shale output by 200,000 to 300,000 barrels per day in 2026, just as demand stabilizes. This could tighten supply, but the real concern is the impact on the industry's future. The crude market's warning signs. The crude oil market is sending distress signals, with the 2026 WTI futures contract curve trading below break-even levels for most shale producers. The backwardation, a feature of the sanctions-impacted 2023 and 2024 markets, is fading fast, with a mere 70 cents difference between November and February futures contracts. Even the ICE Brent futures show a similar narrowing trend, indicating a potential shift in market dynamics. Hedge funds pull back. Hedge fund money managers are responding to these market signals. The net length held in WTI futures and options has plummeted to 29,410 contracts, a mere 15% of what it was at the start of 2025. This drastic reduction reflects a growing sense of pessimism among investors. Market movers. U.S. China trade war. President Trump's decision to reimpose 100% import tariffs from November 1st, on top of the existing 30%, has sent shockwaves through the oil industry. This move threatens to derail the global economy in 2026, with ICE Brent at $62 per barrel, a price that may not hold for long. U.S. LNG developer settlement. Venture Global avoided a BP-like arbitration litigation by reaching a settlement with China's UNIPEC over a contract dispute. Canadian oil producers' takeover bid abandoned. Strathcona Resources withdrew its hostile takeover bid for MEG Energy, potentially opening the door for a Meg-Cenovus merger. Chevron's Greek exploration deal. Chevron is finalizing an exploration agreement with Greece to develop deep-water blocks south of Crete, with surveying to begin in 2026. Shell's Nigerian gas field development. Shell and Sunlink Energies have approved a $2 billion investment to develop the HI offshore gas field in Nigeria. OPEC's optimism. Despite the market's concerns, OPEC remains optimistic about supply and demand dynamics. They maintain their 2025 and 2026 demand forecasts and argue that if OPEC Plus maintains September 2025 production levels, the market will remain in a deficit. Saudi Arabia's Algerian investment. Saudi Arabia's Medad Energy signed a $5.4 billion contract with Algeria's Sonatrach to develop oil and gas fields in the Elisi Basin, a 30-year production sharing agreement. Iraq seeks quota review. Iraq's Prime Minister Mohammed al-Sudani has requested a formal review of the country's 4.43 million barrels per day OPEC Plus production quota, citing reconstruction and population growth needs. Kuwait's offshore gas discovery. Kuwait Oil Company discovered a significant offshore gas field with an estimated 1 TCF of natural gas, boosting the country's energy prospects. U.S. sanctions impact Chinese oil imports. U.S. sanctions on the Rizhao crude oil terminal have forced Sinopec to reroute a supertanker carrying UAE crude, highlighting the far-reaching consequences of geopolitical tensions. India's hydropower strategy. India plans to move 76 gigawatts of hydro generation away from the Brahmaputra basin bordering China, a $77 billion project aimed at reducing reliance on Chinese water flows. China's rare earth exports decline. China's rare earth exports continue to decrease, with a 31% drop in September. as Beijing restricts supplies to Western buyers. Australia's critical minerals deal. Australia is negotiating a critical minerals deal with the U.S., including mandated floor prices, a strategic metal reserve, and joint funding for mining projects. Argentina's LNG expansion. Argentina's YPF and Italy's ENI signed an agreement to build a 12 million TPA LNG export facility targeting a 2029 start. U.S. LNG feed gas demand soars. The Cove Point LNG terminal's return boosted U.S. LNG feed gas demand to a record high. Supported by Plaquemines LNG's ramp-up, Egypt resells LNG cargoes to Europe. Egypt deferred several LNG cargoes from Q4 to 2026 and resold 4 to 5 cargoes to Europe due to lower demand and increasing domestic supply. U.S. and IMO shipping rules. The Trump administration has threatened port fees, sanctions, and visa bans on countries supporting the IMO's net zero shipping framework by 2050, as the UN body convenes to discuss the issue. Brussels approves UAE's chemical acquisition. The European Commission is set to approve ADNOC's $17 billion takeover of Covestro, a significant move in the chemical industry. As the oil market navigates these challenges, the question remains, will the industry find a way to weather the storm, or will these headwinds lead to a turbulent future? The answers may lie in the complex interplay of market forces, geopolitical strategies, and global economic trends. Stay tuned as the story unfolds.